screen.
Sure
Morgan
thing.
Tate, the floor is yours.
Awesome. Well, thanks, Taylor, for the intro and bringing me on today. It's nice to meet a few of you. I met a few of you just now in the breakout room, and yeah, it's super interesting to be here. And the nature of this topic, which is how to maximize your business's value before selling, uh, brings up a lot of questions generally. So I'll try and keep the presentation format of today relatively short, and then maximize the amount of times we can have for discussion, questions. And I think even earlier in the intro chat, there was some talk about rolling up accounting practices, which is very similar to the work that we do. So I think there will be some good discussion today. By means of introduction, there we go. I'm a business broker primarily, so I've been brokering the sale of small businesses for the last 5 years. It's essentially, to compare it, if you've not heard of what a business broker is or does, it's like a commercial real estate agent, except we only operate or only broker the sale of businesses, so operating businesses, oftentimes working on the what we call Main Street level, which is typically businesses that are more owner operated and or under like 20 million in revenue, closer to probably under, the sale price usually between 1 to 10 million in size. And so I broker out of a firm called Schnook Business Advisory up here in Victoria, BC, Canada, on the West Coast. And then by means of trying to solve our own problems, we started a company called Deal Builder, which is the 3 check marks you're seeing here and the overall branding of this presentation. And Deal Builder is an online marketplace to sell businesses and automate the workflow for business brokers. So we basically said like, hey, this industry is kind of out of date when it comes to technology. Let's build some. And so what has allowed me to do is I've been able to not only just have my own experience, which has been about 40 brokered deals myself over the last 5 years. And as a firm, we've closed over 300 over the last decade. But it's allowed me to see the insight into a lot of deals from a lot of different brokers. So from that, I've been able to learn a lot about what makes a successful sale. And probably more importantly than the successful sales is the fact that I've actually seen a lot of failed sales and failed deals. And a lot of deals get blown up or die or what have you as a result. So, I mean, I'm here today to kind of showcase the opposite of that, ways to maximize the sale of your business and more likely actually make your business saleable at all. And I think it's a kind of a universal topic, and it's a good way to think about things if you are a business owner or entrepreneur. So today, the way I'm going to break it down, I'm going to talk a little bit about the valuation techniques for small businesses, the most common mistakes when selling, and then also some financial preparations a business owner can take when they are considering a sale of their business. So the first thing I have is actually a question. I would love to maybe in the chat understand or get people's input on this question, and whether it true or false, most companies are bought, not sold. So if you think most companies are bought, please put bought in the chat. If you think most companies are sold, you can put that in the chat. But oftentimes this is a common phrase that I will hear from people, especially people in the software or technology space, that most companies are bought, not sold. All right, we're seeing a false and not sold, bought. All right, so we're getting lots of good feedback. There's definitely a mixed bag that we're seeing in here. And even most companies go out of business, which is also true as well. So I would say for a majority of businesses, they're more often sold than they are bought. So I think the reason why bought gets thrown around is because when you have this high-flying tech startup, or you see in the news, Facebook is acquiring Instagram because it's this new high-flying startup. But the reality is, that bakery or the maybe the web design agency in your local market is not always getting solicited with buyers coming in through the door. They have to go out to market and they actually have to find themselves a buyer. So on the more practical side of things, I would say more companies are sold in our experience than they are bought. So what we're going to talk about today is ways to prepare and think about it from the aspect of selling your business. So if you don't have a buyer that's coming knocking on your door and saying, hey, I'm going to, back up the Brink truck and just drop a bunch of cash at your door, like how can you actually exit your business as an owner operator? And so first we're going to look at valuation techniques. So there's quite a few different valuation techniques when it comes to operating businesses. One approach is the earnings-based approach. There's a market-based approach, and there's an asset-based approach. I'm going to quickly go over each one. Earnings-based is often you'll probably heard terms of like a discounted cash flow analysis. And essentially what it is it's looking at the cash flow of a business and determining based on the expected future growth of that business and a capitalization rate and a very kind of complicated formula, to be honest, what that business is worth at the present moment. So it's looking at the current value of a business based on the future prospects of a business. I'll be honest, for most small businesses, the earnings-based approach inflates the value quite a bit. It works okay in the public markets, and this is often used in the public markets a lot, or larger scale businesses where you have a better sense of the growth rate of a business. You can kind of make better informed assessments of the business value. You need like a bunch of external data to complete this accurately, and realistically, when you have even a small software company, let's say you do a couple million in revenue, there's just not a lot of publicly accessible data to leverage to do that assessment. So oftentimes, I would say this approach isn't super appropriate for the type of business we're talking about today. The second one is a market-based approach, which takes the business that you're looking at, you find out what the EBITDA is, the most common one of that given business. So this is its earnings before interest, taxes, depreciation, and amortization. So like the actual cash flow to the business owner or investor of that business. And then you're going to compare based on other businesses in the same industry. So let's just say we have a design agency. We're going to look at all the other design agencies of a similar size and see what multiple of EBITDA they sold for. And so that multiple, for simple math, if you made $500,000 a year and you sold your business for $1 million, that's 2 times your earnings. It's a 2 times multiple. And let's say there's some design agency out there that sold for 3 times its earnings, one that sold for 10 times and one that sold for 1. You find a collection of all these different multiples, and then you find an average or one that fits your client's business if you're a broker or you as a business owner, and you say, okay, that is a realistic comparison to us, so we're going to sell for 3 times too. So that is the market-based approach. And then the final approach is the asset-based approach. So this is just looking at the asset value of a business. This obviously becomes a lot harder when you have digital businesses or like service-based businesses where there isn't a lot of hard assets. Sometimes this can be looked at on those businesses as like a customer list could have a value to it. Oftentimes I find if your business is perhaps not super valuable from a goodwill perspective, so in the intangible components of a business, this is where people will go to sell their business. So like, what is that? What are all the assets of the business worth? And we'll just sell it for that. You usually aren't maximizing price with the asset-based approach. In general, like I mentioned, we're going to be looking at market-based primarily when looking at selling a Main Street or smaller owner-operated business. However, the actual asking price or valuation of a business also depends on the type of buyer. So depending on the type of buyer you have, your valuation can move up or down. So really in this case, beauty is in the eyes of the beholder. One buyer might think your business is worth nothing, and to another, it might be worth a lot. And so we have to look at also getting into the lens, if you're selling your business, who is the actual buyer of my business? And so we have a couple different types of buyers. One is a financial buyer, one is a strategic buyer, and one's an entrepreneurial buyer. I'm going to quickly go over the three differences there because there's a bit of nuance. A financial buyer kind of sounds like what the name suggests. It's going to be someone who's really looking at the cash flow and finances of the business and is really looking at the business as from an investment standpoint. So if we go back to that 3 times multiple comparison, this isn't exactly how it works, but they're going to look at it and say, okay, in 3 years, I'm going to make my money back out of this investment. And if I hold the business for 5 or 10 years, I'm going to make an X amount of return over that period of time. Maybe it'll grow and I'll make a bit more. If I use debt, then the actual return on my cash I put into the deal is going to be even better. So they're really going to look at it from a financial lens. Like, how can I optimize the purchase price so I can maximize my return? There's a lot of these buyers out there, and often I think the term private equity group was used earlier. A lot of private equity buyers are financial buyers. They have a fund of money they've raised. They have a target return they're trying to hit for their investors. And so they're going to be pretty ruthless on achieving that return when they buy your business. Now, a strategic buyer, on the absolute opposite, might not even care about your financials at all. So going back to that Facebook and Instagram example, I don't even think Instagram was making any money, any revenue at all, and it got bought for $1 billion, and people thought it was totally insane. But what Facebook saw was that there was a path to leverage what a really good product and monetize it through their existing user base. And now Instagram's probably is bigger than Facebook in terms of revenue, from my understanding, and it's probably worth 200 billion or more. So in that case, buying that for $1 billion was a really great investment. But any of us buying Instagram for $1 billion when it had no revenue would not make any sense at all. So a strategic buyer has an alternative monetization or motivation for buying your business. This also can come up when you maybe are a really great leader and a competitor wants to acqui-hire you. So they know that you're not just going to drop your business to come work for them. But if they buy your business, then potentially they are going to, be interested in bringing you on in that way. So you see that a lot as well in the software space in particular. Then the final one we have here is the entrepreneurial buyer. So the entrepreneurial buyer has some traits of the financial buyer, where they are looking for an opportunity to purchase a business for growth. So they're looking at something where they can apply their expertise, run it as the CEO, and really take it to the next level. We see this a lot in the Main Street world, and often where I see it is from corporate Canada or corporate America, people that have been working in corporate America for a very long time. They have a nest egg saved, and they go, you know what I'm going to do? I'm going to go out and buy a business. I'm going to use the SBA program, acquire a business. I'm going to run it. I want to get more freedom in my life, operate a business. For those of you that own or run a business, know that maybe it's not as free as people picture it being, but they're going to go, hey, I'm going to buy this business. I'm going to take it to the next level. And so that's what an entrepreneurial buyer will look like. So they're probably going to value your business similar to that of a financial buyer. They're not going to overpay like maybe a strategic buyer would be, but they may structure a deal where perhaps there's more upside because they are confident they're going to be able to grow the business. So it really does depend on that type of buyer. When it comes to selling your business, there's some pretty common mistakes. One is owner dependency. This is probably one of the biggest ones. For what we just talked about was valuation. So it's what a business is worth essentially on paper. And then there's saleability, and the ability to sell your business and the value of your business are not one and the same. And then I use this analogy all the time. If you take a YouTube influencer and you look at their YouTube channel, maybe they make $10 million a year. Objectively, it's worth a lot of money. There's value there in what they're doing, and their business is producing a lot of profit, a lot of cash flow, but it's completely unsaleable because myself, if I buy that business, I can't just replace that YouTube personality. The audience is going to say, hey, this isn't the same person, and all of the value will fall off a cliff. Very similarly, if you operate a small business and you do everything, if you own a software startup and you're like the primary programmer and you know all of the code and you don't have anybody else running it, it's going to be very hard for someone to buy it. Or if you're a service-based business and everything goes through you, it's going to be very hard because your buyer pool is going to be limited to someone who can replace you. And that may be really difficult. The next one is using your business as your personal piggy bank. So again, leveraging, reducing your taxes, which every business owner does, but maybe taking that extra line and saying, using a Lamborghini as your company car and writing that off. So this comes up a lot with small businesses that we broker with, and the problem is it makes your financials look really muddy. So you have to present it and say, oh yeah, don't have to worry about these expenses. They're not actually applicable to the business. Well, a buyer's going to go, well, it's hard to know which ones are and which ones aren't. It looks like you're losing money on paper, but you're telling you're making all this money otherwise. It makes it really muddy. And we're going to talk about cleaning up financials on the last portion of this presentation. And then the last one, which happens all the time, is kind of greedy or unrealistic valuation expectations. So a seller, like, not really looking at the numbers and looking at what the marketplace is suggesting, but saying like, I know how much blood, sweat, and tears I put into this business. I want to get top dollar because to reflect all the hard work I did to get it to where it is. Unfortunately, people aren't going to pay for your pain and suffering of starting the business. They're going to pay for where your business is at today. So that is a big showstopper. And oftentimes I've had owners give me this. This is a really common misconception is, I'm just going to put my business at like 2 million, even though you told me it's at 1 million, and we'll see if offers land somewhere in the middle. Unfortunately, that doesn't happen. What often happens is that buyers are going to get sticker shock. They won't even make an offer at all, and then the business sits for a while. So that is a big challenge for sure. So that I would definitely put that as one of the biggest mistakes, if not the most common one I see when people are looking to sell a business. Overall, that leads to you being frustrated as an owner if you're trying to sell, or even, we talked about founders a little bit. If you're a founder of a startup and you have a greedy expectation on valuation, and you're trying to raise money, you're going to get into the same issues as well. So how are ways we can get prepared? So when you're wanting to get ready to sell, we've kind of we've gone into the valuation path. We've put on, maybe gone into the shoes of a buyer and thought, is an entrepreneurial buyer the right buyer for this business? Is it more going to be likely to be a strategic? What's our approach related to that? If you have a strategic buyer, then it's a very different process than if you're trying to sell to a financial buyer. You're going to also value the business maybe differently. Now that we've kind of figured that component out, what we need to do next is get ready to actually present our business to a buyer, regardless of whether you're going to the marketplace or if you're just directly advertising to a buyer. You're going to need to do a few steps. One of them is going to be building a deal team. So this is your lawyers, accountants, and potentially bankers. So one of the best things you can do is talk to the bank, see if your business is actually eligible for financing through the SBA or other lending programs. If you don't have an accountant, leveraging an accountant to get your financial statements up to date and your tax returns all done, and then having a lawyer do some work as if they were the buyer's lawyer. So checking your corporate books and records, ensuring you have contracts with all of your employees and customers, and there's nothing missing that will be flagged later in what we call due diligence. I'll talk a little bit more about due diligence in a moment. After that, you're going to put your buyer hat on. So even if you're not planning to sell, this is actually a useful exercise to do in an annual review of your business. Put on a buyer and go, okay, if I were going to be as brutal as possible in my analysis of this business, what would be things that would scare me? And that could be your revenue mix. Like, do you have a lot of customers is all your revenue tied to one big customer? Do you lack to have multi-year contracts with those big customers? What are some of those things? Are there key employees that aren't on longer term contracts? Things that would give a buyer pause, and then start working on ways to address each one. And then the last thing you can do is trying to get everything out of your head as a business owner and into the business presentation. So that's writing standard operating procedures, documenting everything that you do so that you could hand it off to a team member or a general manager. They could step in and start running your business. That's a massive one and allows transferability to a new purchaser. So if a buyer comes in, they can put a new CEO or a general manager in place without fear that the business is going to fall apart because you left. And even better, if you can start working on delegating as much as possible off your plate, then it really doesn't matter who buys your business because you're not actually the one running it anymore. It's the CEO or general manager who's going to be running your business for you. Due diligence is a big component of a deal. So after you've accepted an offer from a buyer, so we're fast forwarding on the timeline a little bit here. Let's say you get an offer, you like it, you accept it. Due diligence is going to be basically a very thorough process of a buyer looking at everything that could possibly be wrong with your business and doing a deep dive on your bookkeeping, accounting, contracts, severance liabilities, you name it, buyer's going to look at it. A way to get ahead of this process, because it happens no matter who you sell to, is actually building what is called a data room. So this is basically, for lack of like a simple term, like a Google Drive or a Dropbox filled with folders of different documents that a buyer is going to request. With our deal builder system, we actually have a built-in data room in the application. And what we do is we actually have our clients pre-populate the data room in advance of going to market. So we're trying to anticipate, hey, buyers are going to ask for this, so you might as well prepare it now. Because the worst thing you can do is that you're out to market, you got a great offer for a business, and they go, hey, could you send us your trailing 12 months of profit and loss statements? And you go, I would, but my bookkeeper is 6 months behind on my books. Well, now what's going to happen is there's a huge delay in getting the books up to date. One, it makes you look bad because the buyer's going to say, well, your bookkeeping is really behind, and it kills all momentum. So what we want to try to do is keep momentum high because time kills deals. So keep moving things along so we can get to a closing date as soon as possible. So there's a question from Ryan about, do brokers help with the due diligence process? Yes. So as a broker, you're typically kind of quarterbacking the entire deal. So what I do in due diligence is I'm helping buyers facilitate a list that they're going to ask, a request list from a client. And then I work with the client and the client's lawyer and accountant to populate those items and then answer any other questions that might come up. We're kind of sitting in the middle. Typically, we're facilitating a lot of due diligence happens between a buyer's accountant and lawyer and then the seller's accountant and lawyer. And we're kind of in the middle helping, making sure everything's staying on side. Sometimes you get a lawyer or accountant on either side go a little bit rogue and refuse to offer certain documentation or ask for something that's a little overzealous in their request. We kind of play referee and make sure everybody's staying on side, and that's kind of our role throughout the due diligence process. So last little bit here before we get into the Q&A is the financial preparation of a sale. So I'm going to go through a quick checklist of things that you'll want to do as an owner on the financial side. First is a bit unintuitive, but it's paying yourself a market rate salary if you are the operating general manager, CEO of your business. And so what this does is that it shows your profit more appropriately for a buyer and allows you to eventually hire for your position at the same rate. When you underpay yourself a market salary, the thing that gets a little complicated is we can go, yes, buyer, the owner is pretty confident you can hire a CEO for 100 grand a year. They're not paying themselves a salary now, but we think we can hire someone for 100 grand a year. So we'll adjust the financials to show that. That's fine. But if you're actually paying yourself that market rate salary and it's comparable and you have market data that you can back it up, it just makes it easier for the buyer to say, okay, yeah, we can put out a job posting after we acquire this business, and we're pretty likely we're going to find somebody that can fit that role. So paying yourself a market rate salary, even if you're paying a bit more in taxes versus dividends, is usually a worthwhile thing in the last couple of years prior to selling. On that same thread is pay your taxes. So when we talked about using your business as a personal piggy bank, stop writing off every personal expense, particularly if you're 2 or 3 years out of selling. Keep your books as clean as possible, because every time you have a personal expense running through the business that you need to back out of your financials to show true profitability raises a question for a buyer. It makes everything just a little less tidy, and the banks don't love it either for lending. So pay your taxes, you'll pay a little bit more on the profit of the business, but showing a higher profit prior to selling is a good thing because that's what ultimately drives the valuation of the business. Then you'll want to get accountant prepared financials. So if you prepare your financials yourselves, or if you got a bookkeeper that's doing them and they're not done by an accountant, you're going to want to start getting those done by an accountant, getting them to a high standard, one that matches whatever the lender is going to want to see as a part of their lending process. So the SBA is the primary cash flow lender in the US. So you're going to want to talk to maybe a local SBA lender and figure out like what standard of accounting financials do I need for your SBA 7A program. That would be a great step to have. It's a little more tricky with software companies, but it doesn't hurt either to have an accountant actually prepare your profitability because it's going to, again, boost buyer confidence, which helps increase the likelihood of closing. Another one is minimizing revenue concentration. So revenue concentration is, using an example, let's say you are like a B2B software company, you sell to other businesses, and you'll have a high ticket service. So let's say it's your clients pay you about $200,000 a year, but you're doing on average for a contract for the year. And let's just say one of your clients pays you 800,000, you got a couple others at 200,000, but you're only doing like a couple million of revenue. That one $800,000 client, if they leave, your business is going to get cut dramatically. So a buyer's going to look at that and say, they only have a 1-year contract. If we buy this business and they cut the contract because your relationship as the owner is the reason why they were interested in even staying with you, is going to raise a lot of question marks. So the best thing you can do is not cut that $800,000 a year client, but instead add a bunch more $200,000 a year clients so that your total revenue is 3 or 4 million and they're just a smaller portion of the whole. So, or increasing all your other clients up so that their average revenue is up across the board. So that is a big one. It can come up. I've seen it kill a lot of deals because there's just so much fear and uncertainty. And oftentimes the only other way around it is have a deal structure where that client, a big portion of the deal is conditional on that client sticking around for 2 or 3 years, and you get slowly paid out for your purchase price over time, which is not as ideal. Another one here is going to be pulling excess cash out of the company. So when we sell a business, it's typically done on a cash-free, debt-free basis. So any excess cash that's not used for day-to-day operations is dividended out to the owner, and then any debt on the balance sheet is paid off from the proceeds of the sale. So similar when you sell a house, you sell the house and you pay off your mortgage. The buyer typically is not going to inherit your mortgage and pay you the purchase price on top of that. So that's similar in this case. What I have found is that if a buyer sees you got $1 million worth of cash in the company, they will sometimes they'll include some of that cash as a part of the purchase. They'll want you to leave some cash behind for them. And the bigger the number, the bigger the inclusion is. Just kind of human nature. If it's lower, it does help bode you well. So that is something I would recommend doing prior to starting the process of selling. And then the last one is talk to your lawyer, accountant about tax exemptions. Are you incorporated correctly? Is there things you need to do years in advance? So I can't speak to this because I'm not an accountant or tax lawyer. And I also don't know the US system as well as the Canadian system. But in Canada, for example, if you are not an incorporated company, you miss out on a big tax exemption on the sale proceeds. You basically get an exemption from capital gains, but you can't just incorporate before the sale, because if you do, you have to wait 2 years to be eligible for the exemption. So if you don't know that going in and you go to sell, it can be a very costly mistake for a lot of Canadian entrepreneurs. So I'm sure there's parallels and similarities in the US. So again, involving your deal team and involving your advisors is super important. And then hopefully, rather than having your hands in your face at your desk, you're going to be feeling a lot better. So I'm happy to open it up to Q&A and to learn more. If you want to reach out to me, I'm Morgan at dealbuilder.co. This is also our website is www.dealbuilder.co. Or you can visit my personal website, which is morgantate.com. And yeah, happy to open it up to questions.
Morgan, this was awesome. Thank you so much for the presentation. If you've got questions, maybe there's one in the chat, but you can either throw them in the chat or just unmute yourself. Looks like Nathan Nelson said in the States, we have the amazing QSBS. Look into it. 1202. Yes, that is a good.
I have heard of that, and it is pretty amazing.
Yeah. But yeah, you can either raise your Zoom hand or unmute yourself. Morgan, I'll jump in with the first question while people are either writing in the chat or thinking about raising their hands. You mentioned stop using the company as a piggy bank 2 to 3 years before the sale or the expected sale. Did I hear that correctly?
Yeah, well, it's ultimately you should probably just do it anyways, just from a tax liability perspective. But yeah, prior to the sale, typically what we do, usually the last 3 to 5 years are used in the assessment of a business. So that's kind of a timeline to work off of. Having only 1 year is kind of hard to say. It's like you've gone from not making much money and suddenly you have a really good year because you've removed all these like other expenses. Isn't always present the best. So having a few years of that is better.
Okay.
Patrick's got his hand up too.
Yeah, go ahead and unmute yourself, Patrick. Thanks.
Thanks, guys. Appreciate it. Great presentation, Morgan. Really appreciate a lot of the insights and everything. I have 2 questions. Number one, as a firm, kind of what is your blend between, or do you do more buy side or sell side, as a broker? So that's the first question. Second question is, how often on the financial due diligence, I'm known as the QV guy, so I got to ask, how often do you involve a QV? And do you see that more on the buy side or sell side?
Yeah, no, great question. So I'll speak towards the first one. In the space that we're playing, like that sub $10 million transaction, it's almost all sell side. I think as you move up market, you get a bit more buy side engagements and work. And for those on the conversation, buy side and sell side is essentially just, are you representing the sellers who are selling, or are you representing the buyers who are purchasing the business? So I would say, yeah, 90% of our work is sell side, probably depends on the year, but even more. So almost all sell side. And then on the QOV, it's interesting. In Canada, we have a much more standardized accounting standard. So almost every single business has accountant prepared financial statements. Even sole proprietors will have a accountant prepare their financial statements sometimes, even just for their personal corporate tax returns. So there's a little less buyer worry. We do have to get like statements upgraded to a higher level of accounting. But I found working with US clients, it's kind of like the Wild West in terms of like you got cash and accrual, and almost everybody in Canada is essentially accrual. So it's all very standardized. So you get a little bit less buyer QOV. There's definitely financial due diligence that's done, but it's a bit different. However, talking to the brokers that are listed on our platform that are from the US, QOV definitely starts to come into play as you move up in deal size. And I think it's a great thing to be able to say, like, as a broker, like, hey, this is QOV has been done out, not from us. Like, we're not doing the QOV. It's actually better if it's not coming from us, because we don't want to vet the financials of the deal. I would not put my name on something and say, hey, I've done a deep dive on the financials and this is the true EBITDA. This is the EBITDA based on what the owner has told us, buyer beware, but here's a Q&A to back it up.
Plus it gives that third-party diligence, or sorry, that third-party validation. Yeah,
and then going to lenders as well, that's helpful. I think as with the SBA, oftentimes they'll require it over certain lending thresholds. So yeah, definitely coming up more and more.
Thank you.
Morgan, there are a couple of questions in the chat. Parker, do you want to come off mute and ask your question? And then Ryan, you can do the same.
Yeah, sure. And thanks so much for the presentation. just a question around like how long this takes on average. Like if I wanted to sell my business in 2 years, when should I start building a due diligence and maybe working with a broker or just looking for buyers?
Yeah, so it never is too early to start. I say, like on the data room side, it's like just keeping like, even again, like in a Google Drive, you just every month take your bookkeeper return P&L and just put the monthly P&Ls and just organizing them, putting all your tax returns per year, putting all of your employee contracts. It's just like good housekeeping to have is due diligence effectively. And then other like special things you can do at the time of. And just kind of putting everything that you think is like an official document of your company all in one place is really helpful. And then there's lots of templates and examples you can find to start putting that together. The average sale of a small business, so like smaller owner operated, can take 8 to 12 months. So it's a pretty long process. I've done deals that are, 90 days. I've done deals that are even shorter. I've done deals that are taking like 2 years. So it really depends on the business, and again, like how saleable your business is. If you have a business where it's not very dependent on you, it's profitable, it's at a certain size, they sell pretty quickly. But if it's a very owner dependent business that's small, it's going to take some time to find a buyer. So that's kind of my general guidance. If you're 2 years kind of out, I would say spend the next year trying to remove yourself as much as possible, document everything, put everything in the data room, and then look at engaging with a broker at the end of that 12 months and maybe getting started in the process. And it might be even faster than a year, but then you have options.
Awesome. Thank you.
Ryan, if you want to come off mute and ask your question, I think timing wise, this will be the last question for today. We've had a great discussion. Thanks all.
Yeah, thanks, Morgan. I'm just curious what you just mentioned some in the last comment, but what makes a good deal is from both the buyer and the seller side. I mean, what kind of are people looking for when they're looking to buy businesses? And
For sure. Yeah, if you want like the most, I'll just do the general one because it really obviously depends, like I said, depending on the buyer and things. But if at a universal standard, if you are producing over $500,000 in profitability after you pay yourself a market rate salary, and the business has got a management team in place that's not dependent on you, and it doesn't have to be really even growing much, and it's mostly recurring revenue, like those businesses transact like that. So that's like a really good threshold. Is I would say profitability more than revenue. If you had $100 million revenue business, but it lost $500,000 a year, or you had a $1 million a year revenue business that made $500,000 a year, which one are you buying? And it's probably not the one that's losing money on 100 million of revenue, because that sounds like a really hard business to figure out. And maybe there's opportunity in there, but in general, it's take a more specialized buyer than someone who's like, I got a 50% margin of safety, buying the smaller one that is going to be consistently profitable. So that's the main one, is profitability drives kind of everything for sure.
Awesome. Thank you, Morgan. This is awesome. Amazing information. And if I would recommend any of you reaching out to Morgan, I think he threw his contact info up earlier.
I'll put it in the chat too for you.
Yeah, that would be great in the chat. And we'll send out a link to the recording as well if you'd like to review this. So pull Morgan's email out of the chat right now before you leave. But thanks everybody, and we'll see you all next week. Same time, same place.
Thanks, Taylor. Thanks.
Thanks so much. Thanks, Morgan.